Hello, everyone. Welcome to our second WOW event of 2020. We hope that you're all doing well out there and staying safe and you're all healthy. It's a little bittersweet for me, even though I love doing these events. I miss seeing all of your faces. We have quite a few attendees on today, so I hope you enjoy it. A few housekeeping items real quick. Before I introduce our presenter, Jeffrey Rodriguez from Social Security. We're going to have the presentation's about 45 minutes long. At the end of his presentation, we will have a Q&A section. So we want to make sure you know how to submit a question. I encourage you to ask questions along the way and type them in the question box on your toolbar to the right of your screen. Hopefully everybody can find that. If you have any questions throughout, go ahead and submit it. We're going to try to get to all the questions, but if we can't and we run out of time, we will follow up with an email to you answering your question. As always, we encourage you to reach out to us and schedule your quarterly reviews, or if you have any questions for any of the APRIAM team. As I mentioned, we do have a few new attendees on who this is their first WOW event, my Women of Wisdom events. I'm so super excited. This is our 7th year. It's hard to believe coming up in 2021, and hopefully those are back in person. And again, in 2020 can be a thing of the past. I know it's been difficult for everybody involved. So my name's Rhonda Ducote. I'm the president of APRIAM Advisors, but more importantly, I'm the senior wealth manager here. For those of you who don't know me, I started WOW again 7 years ago to empower, encourage, and educate women to take a more powerful role in their finances. These are educational events that we hold, and we're so lucky to have speakers like Jeffrey join us to educate our clients. Social Security is always a big topic that comes up in our financial planning meetings with our clients, as well as just in general. When should you take it? What's the benefits of waiting to full retirement? Or should I even push it out to age 70? Those questions always come up, as well as how much am I going to get? And what's the most benefit I can get from Social Security. So with that, again, at the end of the presentation as well, we're going to send you an email with a survey for your feedback to let us know what you thought of the presentation and how we can improve going forward. So please, if you'll take a few moments to fill that out, I would really appreciate it. I don't have any of my WOW girls here with me today, but they all say hello. So Sean, Lindsay, Sunny, Megan, and Jennifer all say hello. And without further ado, I'm going to introduce our speaker and get him going. As you can see, he's on the screen already, Jeffrey Rodriguez. He's worked as a public affairs specialist for the Social Security Administration since 2009. Jeffrey educates the public, community, organizations, and media contacts about Social Security programs and the benefits of it. He makes presentations and speeches about a variety of Social Security issues throughout the counties of Orange and San Diego. So we're so honored to have him here today. I'm going to turn it over to Jeffrey to get us going, and we look forward to hearing everything and all of the plethora of knowledge you have to give us on Social Security.
All right. Thank you very much, Rhonda. I appreciate it. And it is always a pleasure to be with you and to be able to do this. As said, you know, not my preferred way either. I always enjoy seeing everybody face to face, and but this works as well. And so I'm just glad that we have this opportunity and the privilege for me to share all of the Social Security information, those things that really are important to us. And there are or have been some minor changes as we go through, and I'll share those things so that you're aware of kind of what's going on currently, obviously due to the COVID. So let's go ahead and get started with you through life's journey, Social Security. And a few things, just a quick note. The information that we'll go over today is 2020 updated as best as I can up to right now. But keep in mind, any changes that happen post this event and time that we have today, the best way to make sure you have the most current information is to go onto our website. So just keep that in mind as well. All right. So one of those is, as I said, going to our website. A lot of times what happens is, as I give the information, people are, very thankful. They're listening. They're taking notes. They're capturing the information that's shared. And I always get a lot of positive feedback, and I appreciate that. But I also know that one of the things happens even when I attend some type of workshop is right immediately afterwards, a lot of those questions, once that individual's gone and we can no longer ask the questions, or a day later, we forget everything that's going on, or we don't remember everything quite the way we should. And so one of the things that I bring to attention is our website, because that's, as I said before, to me, the best place to go and to get the information. I use our external website more than I use our internal website, meaning I find it easier to find the information, to look to see what we have, what's current, whether I'm using the different, blogs or our news press releases, things that are there. So I would suggest, the same. Use our website, and even initially, even after this, go through our website, get kind of updated, look for some of the FAQs. That'll help you, bring you up a little bit more to speed. And then when you reach out, if you need to one of our representatives in our local offices, then you have better questions that are more directed towards your specific situation, rather than just a general question that you might be able to find here and save yourself some time. And instead of asking the general questions that you could have found here, you'll be able to ask, again, those questions that are specific or unique to your situation. And it really is. We realize that your situation, each as individuals, are very unique. Even if someone has done and worked at the same place and it looks very identical, it still is going to be different and unique once we look at each person. So do keep that in mind. Now, one of the things that I personally got to work on a national level was the redesign of our retirement page. And I love this page. I love what we were able to do. A lot of the input that we put in, they were able to capture, and our IT was able to design it. And if you take a look here, this is our new retirement section. And when you look at it, what I really enjoy about it is the way that we have it set up. If you look there, it says learn, apply, and manage. And those are the three basic ways that you're trying to capture information, whether you're learning pre and prior to taking a benefit, a Social Security benefit. That's the section where you're going to find out, how do I plan for it? What should I expect? How do I know how much I'm going to receive? Those types of questions and those links and publications that would be under that section. Then the middle there, apply, would be once you're ready to, and you've determined, okay, now I want to apply. The best way to do this is online, and I'll kind of touch on that at the end of the presentation as well, to remind you those methods that you can use, but definitely online is the best way. And then once you apply, it's managing. What you need to know post entitlement, after you start receiving your benefits, what types of things should you be going back in and looking at? What do you need to understand about your benefits? What about survivors or spouse benefits? Those types of things, that would be under managed. So very easy to find the correct information at less clicking through and searching. They're right there. What are those three that you need to know in retirement? So please do use our retirement section, and I think you'll find that that page to be very easy to use and just a great source of information. The next is obviously creating a My Social Security account. If you have not done so already, I would urge you, plead with you, please, create your My Social Security account. This is where you're able to go in and get your information, to view your information, everything that is on your record, those things that you need to look at, how much benefits you're eligible to, those types of things, calculators, your earnings record, which is very important when you're taking a look at, how much did I pay into Social Security? And it's not just to kind of take a look and say, well, look at me, how great, I earned more money. Look at these years, I've increased my position, whatever it may be. Although that helps, and it's a good, little pat on our backs, but really what we provide, that earning record, is so that you can go in, and as you go in and take a look at it, we're trying to ask, are they correct? have you review them and make sure that they're correct. As a matter of fact, when you go to apply for benefits, we're going to ask that exact question. We're going to say, have you reviewed your earnings record, and is everything correct on there? Because when I go through the next few slides here, you're going to see it's very important that you have that we have, Social Security, the correct amounts that you've paid into so that your benefit will be correct. So a lot of good information, again, whether you're doing it prior to benefits or after benefits, right there on the My Social Security account. And if you need to print out a statement of your earnings, right there, you don't have to try to get to an office, which right now our offices, you're not able to walk in, and we're only taking appointments for those that it is required that there's a certain need where we have to see you face to face. And for most of the business, we don't need to. And so I'll share with you how you can contact your office, your local office, at the end here of the presentation. So let's move forward. Those things, again, are the informational things that are really important that you should know and be aware of. Now, when we talk about the first steps here, kind of building blocks, how does one qualify for a Social Security benefit? When we're talking about, to be eligible to a Social Security benefit. And as you can see there, the biggest part, and maybe in the future I'll change these around, but it's the 40 credits. In order to be eligible, you have to reach 40 credits. When you've hit your 40 credits, then you're eligible to receive a Social Security benefit. How do you obtain those credits? Well, when you work, you can earn a maximum of 4 credits per year. Currently this year, for every $1,410 that you're earning and paying Social Security tax on, then you're going to receive 1 credit for maximum in a year. So $5,640 or $5,640 this year would give you those 4 credits. Now, most of us have already attained that. You've already worked that approximate 10 years worth of work. So you qualify, you're entitled to a Social Security benefit. And so once you reach those 40 credits, we don't have to talk about credits any longer. There is no extra credit. This isn't kind of like school or class. If I have 50 or 60 or 70 credits, that doesn't change anything. And matter of fact, we stopped counting at 40. So there, I would even ask, how do you even know you have those many credits? We don't count them any longer. How do you know you've hit your 40 credits? Let me go back one again here. If you see your benefit and it gives you a benefit amount, so your record says, you go into the My Social Security account, you pull it up and it says you're going to be eligible to X amount at your full retirement age. Once you have that number, or you've seen on the statement maybe that you used to receive, because we don't mail those out any longer unless you're age 60 or older, but everyone else we stopped mailing. We're saving over $11 million by doing so. And so you'd have to have seen that dollar amount that you were eligible to. You hit your 40 credits. That's a moot point at that. We don't have to worry about it from there on. So now let's talk about how much are you eligible to receive? How do we determine that? And what are some of those strategies that you should be aware of when you're looking at benefits? So once we have the 40 credits, we know you're eligible. This is how we figure this out. And this is why it's so important that you take a look when you're looking at your record, your earnings record, and everything else, that it's all correct, because we are going to use your highest 35 years in order to determine a average monthly earnings amount. So we take your highest 35. It's not sequential. It's not your past 35. It's the highest 35 throughout your lifetime. Once we have that amount, then we can determine that monthly earnings amount. But keep in mind, you may say, well, way back when, it should be the last ones, because way back when it was so, much less. But we use these multipliers or these factors in order to determine, and we index for inflation. So oftentimes the work that you've done maybe 30, 40 years ago may be, and it's common for us to take a look in those early years, 2 or 3 of those years are going to be in the top 35. Even if you're hitting the higher ends of the maximum that you can pay into on the more recent side of your work history, those early ones with those index amounts do make a difference. Like in 1980s, it may be, 15,000 turns into 40,000. So just keep that in mind. And as we get going and closer to time-wise, at some point, we stop the indexing, or there's no longer this inflated amount, so then the older ones may surpass the more current, and that's what I'm talking about. So we take your highest 35, the average, we then drive it through what we call bend points, B-E-N-D, bend points. Those bend points change every year. So the first $960 of that monthly average, and so let's say that your average monthly earnings are 5,700. After we take the highest 35, the average is 5,700. So the first $960 of that portion, as you can see there, is going to be used in order to give you that 90%. That's the biggest portion there that you're going to receive back, is that first, or percentage-wise, is that 90%. So of the 960, and again, you have to check each year because that amount will change, meaning there's going to be a type of inflation. It's not the true cost of living that we push out every year. It's kind of separate, but it does mirror it a little bit. Then the next bend point or bracket there is the largest portion of your average, which goes from this year 960 to 5785, where you're receiving 32%. Now, when we look at Social Security benefits, we say, you know, you're roughly about a third of what you get from Social Security is going to be there to help you in retirement. And that's because of this right here. 32% of the largest portion of your average is what you're going to receive. Some will go up as high as about 40% is what you're going to get of your what you need in retirement from Social Security, but roughly a third, and that's because we're giving you the bulk is 32%. So the other portion is where you're leaning on the experts to help you and manage that wealth and retirement planning in order to make up the difference so that you can live comfortably in retirement. And then the final, if you see there, the final bracket, if you had over this currently this year over 5,700, you would get 15%. And so it just depended on how much you've paid in, whether you would have something in that third bracket or if your average is going to be used in the first and second only. Now, once we come up with that final number, after we add all these up, that's called your primary insured amount. So in this example, the 2380 is the primary insured amount, the PIA. Primary insured amount is your full retirement age amount. That's for us to be able to say, okay, everything derives off of this PIA, whether you're taking it prior or you're going to take it after, it's off of that PIA. And we'll go through and I'll explain some of those strategies as you look at, you know, the PIA and how that comes into play for you. So in this case, once we added this up, 5,700 of the average over the highest 35 would pay out at full retirement benefits 2380, or the PIA. So once we know that PIA, we can now determine, okay, what are you eligible? When can you take these benefits? How do you know when to take these benefits, and kind of all of that. So we'll start with the youngest or the earliest age at which you can receive benefits, which is age 62. 62 is that starting point. So we form that base, if you will, at age 62. But you can see that there is, or well, you'll see the first of, there's two things that are going to impact you. So just keep that in mind, two things. The first is there's going to be permanent reduction off of your full retirement age, that PIA. We're going to reduce you down depending on where you start. Now, we use a month-to-month reduction factor from your full retirement age. So you need to know what your full retirement age is. So let's go there. And as you can see in this chart, we have a kind of a sliding scale, if you will, dependent on the year of your birth. So right now, 66 is the full retirement age. So I'm born in 54, would be age 66, which is 2020. Starting next year, or those born 1955, we're going to tack on those 2 months. So 66 and 2 months, and then every subsequent year, it's an additional 2 months when we're determining the full retirement age, going all the way up for anyone born 1960 or later would be at age 67 for the full retirement age. So keep that in mind, because if you look at the last column, what we're telling you there is that if someone in those, whatever your full retirement age is, or the year that you were born, if you took your benefits at 62, that earliest point, it would be reduced by 25% all the way up to 30%, because if 62 remains constant, but the full retirement goes from 66 to 67, well, then obviously the reduction is greater, and that's what that 25 to 30% is telling you there. But I give a different number, because unless you're taking it right at 62, and I've said that these are month-to-month reduction factors, then how are you going to know, what is the reduction, or what percentage should you expect? So the easy way to do it, ballpark figure, is it's 0.5% for each month early that you take it. So let's say you're not taking it at 62, but you're taking it 40 months early. 40 months early, 0.5% per each month, so roughly 20% reduction. And so if you had, let's say, 2,000 is your benefit amount at full retirement age, your PIA, then the 20% reduction off of that $400, you'd have a benefit of $1,400, rather $1,600 would be your ongoing benefit with that permanent reduction. And keep that in mind, this is permanent. It will not go back up at your full retirement age, or age 70, or let's say you make it and you become a centenarian. We still don't increase or remove that reduction. Once you start your benefits on your own record, if you're taking it prior to your full retirement age, that reduction on your record is always going to be with you. So even if we have a cost of living, or even if something else happens, we say you go back to work and that becomes one of your high years, and we recalculate it, which we do automatically, and we increase your PIA, the reduction is still the same, the percentage. So in the example I gave you, if you're taking it 40 months early, you'll always carry a 20% reduction. If you're doing 20 months, well, then 10%, or 15 months, then it'd be that 7.5. That's just a ballpark figure, but there are calculators that you can go onto our website using the My Social Security account, or even just in our on our website, and look those up, and they're very accurate. If you put in all that information that it requires, then what it provides for you is extremely accurate, although we call it an estimate, because until we do the final, based on the actual amount that's on your PIA and what the actual reduction would be, everything else is an estimate. Now, there was two things, I said two things that were going to impact you. So we only talked about reduction so far. So if you start your benefits prior to full retirement age, then you can see here that there is an annual income limit. And for 2020, if someone started this year and was below their full retirement age, meaning that they are started their benefits prior to full retirement age, then 18,240 is the annual limit. Now, what are we talking about when we say the income limit? We're only looking at the income that counts is earned income. So we're looking at gross wages, W-2, and net earnings from self-employment. So if you have your own business and you're doing the self-employment 1099s, or your own business, then you have to wait until we see what your net earnings are. That's what would be contributed towards this limit. So gross wages and limit. So 18,240. If you're earning anything above that while you are below your full retirement age, then you're going to be penalized, and we're going to withhold some of your benefits, making that a selection or choice to take it early not a good choice. So you want to make sure that if you're going to start your benefits prior to full retirement age and you're willing to take the permanent reduction, just make sure that you're going to earn below the annual limit. Now, the next to that, you see the year of your full retirement age, and you can see that then the annual limit goes way up from 18,000 up to 48,000. And that is to say this. So say you wanted to start your benefits at the start of the year in January, and it's the year that you're going to hit your full retirement age. So hopefully you wrote down, or you remember what your full retirement age is. Let me go back, oops, right there. So you can see, depending on the year of your birth, what your full retirement age is. When you look at this, if it's the year that you're going to hit your full retirement age, whether it's 66 or 66 in a few months, or 67, whatever year that is, the annual limit goes up. And what we really are saying there is between January and the month prior to when you attain your full retirement age. So let's say I'm going to hit my full retirement age in July. well, then we're only looking at January through June of that year that I'm going to attain my full retirement age under the 48,000. So let's say I make 70,000 a year. Well, January through June, half of that 35,000, if I make 70 a year, then I could, because it's below the annual limit, I could start in January versus waiting to start in July. Now, why would someone do that? Now, if you don't catch this right away, don't worry about it. We can talk about this later. You can read up on this, but just keep this in mind that say this is you. You're going to hit your full retirement age, and the months prior to your full retirement age, you would be below that annual limit. Why would you start in January? So let's use the same example. July is your full retirement age. January through June, you're under the 48,000, so you start in January, which is 6 months early. What is the reduction on 6 months? Well, 0.5% for each month. 6 months would only be 3% reduction. So let's use that same $2,000 that you are eligible to at full retirement age in July, but you're taking it 6 months early. So 3% off of the 2,000 is only $60. So you're going to get a $1,940 that you're going to receive for 6 months. So if you take that $1,900+ times 6, and you come up with that total amount, and you divide it back by the difference of that $60 difference that you're talking about, how long or how far ahead does that push you? And the answer is going to be probably more than 10 years. So that means that you wouldn't make up that difference by starting early until about 10, 12 years down the road. Now, think about that. If $60, for taking it a few months early, or $50, whatever that amount is, if that's really key to you, and you say, well, 10 years from now, if I don't have that $50 to go and buy a cup of coffee, it's going to, ruin my day. Well, then that's fine. That's what you need to do, and you wait until your full retirement age. But maybe under this strategy, you can take it early, and that money that you're gaining ahead of time, maybe you invest back. You're taking it early, you're starting early, you weren't expecting to, you're still going to be working, and so you maybe don't need your benefits, but you plan to do some other type of investment. That's an option and a strategy that you could use. Again, it depends on the individual. Now, if someone is in December and they make 70,000, well, then you can't start in January because you're over the annual limit. So it really does depend on the individual, when you hit your full retirement age, how much you're going to earn in the months prior, if you could do this and gain by this strategy. And I would even say someone who's going to gain by 1 or 2 months, that's potentially still a good strategy, as long as you're going to be below the annual limit. Once you hit your full retirement age, no more. We're not counting income at that point. Or if you waited until your full retirement age, then you get 100% of your benefit from that month on. So if July is your full retirement age, no matter when your birthday is in that month, and that's your full retirement age, for the entire month of that, when you attain your full retirement, that's when you're eligible to it. The only exception, and I hate to throw this out there, but just in case, if your birthday is on the 1st of a month, then you've actually attained your full retirement the month prior to that. So if your birthday is July 1st, then you actually hit your full retirement age in June. Now, don't ask me why Social Security does this. Just accept it as a free gift. Again, if your birthday is on the 1st, you actually hit your full retirement age the month prior. So, but if your birthday is anywhere on the 2nd or after, then it's that entire month, meaning if it's in July 15th, you have the whole month of July, you're eligible to start your benefits. You could continue working. Earnings is no longer any factor that we have to worry about. You could continue to earn. And I've seen someone that was earning 500,000, actually over 500,000. Now, I can't give the person's name, can't give too many details, other than to say, when I took the claim, and this was about 8 years ago when I was still doing claims, the individual, in my mind, I'm thinking, why, you're making so much money, why would you even start it? Allow it to go into delayed retirement credit, which I'm going to talk about in next year, delayed retirement credit. But I was thinking, why wouldn't you just let your value of your benefit increase? When I took the claim, I realized this individual they had started the family late and they had a minor child. And so his son that was 15 years old, he could receive for those 3 years until he became age 18, adult, and finished high school. His son was going to get 50% of his PIA. Obviously he earned a lot of money, paid a lot in Social Security, so his benefit was quite high at that time. I believe it was like $2,400. So his son was going to get $1,200 from that point when he started receiving up till his son reached age 18 or graduated from high school. And I don't remember which was the case there. But what he just did by doing so is he increased his benefit by 18, about over 15,000, 16, 17,000 a year that his son, that he could save and put away for his son over for 3 years. So you have to look, there's some strategies and different things that you need to be aware of. So as I said, the other option would be waiting till you hit age 70 and you're going to gain what's called delayed retirement credit. Now the delayed retirement credit is if you wait for that 12 months or every year, you're going to gain the 8%. So from 66 to 70 would be 4 years. 4 times the 8, 32%. If your full retirement age is 67, then 67 to 70, 70 still remains that limit. You never want to wait past age 70 to start your benefits because you're losing money. You're going to be throwing away money. So 67 to 70, 3 years times the 8% per year would be that 24% on top of whatever the PIA is. And so that's pretty significant in a time period where you can't increase your income any longer. Maybe you've stopped working. The 8% per year is a great amount to receive. And so a lot of, when you look at planning, many believe that that is an excellent way to do it. Me personally, I say you really have to look at all of your options and determine which is truly the best for me, my situation, and what do I want to accomplish with my Social Security. So let's take a quick look at just kind of a recap. If you take the early reduced retirement benefits as early as 62, anywhere in between, 0.5%, 0.5% for each month early that you take it, as long as you remain below the earned income limit. Now you can take a look each year to see what is the earning limit for this year. I started early, I want to make sure I'm below. It does increase every year, so you're going to have to take a look to see what it is. If you waited till full retirement age, you could continue working, 100% of your benefit, no income limit, and you're receiving benefits. Or perhaps you waited and you said, I'm going to take the delayed retirement credit, get that 8% per year. I don't want to pass up on a great opportunity like that. I'll just wait till age 70. I'm working, or I have other means, I'm okay. And maybe that's the option that you want to take. Now, with all of that being said, there is also spousal benefits. And this, there is, I don't want to say confusion, but I want to make sure that we're clear on how the spouse benefits work. If a spouse wants to claim a benefit on their spouse's record, on the number holder's record, they are potentially, and I'm going to use that word potentially, eligible, because there used to be this option that once you the file and suspend is what it used to be called, and someone could at age 66 take their benefit, file the claim, and then suspend it, voluntarily suspend it, gain the 8% per year, opening up their claim to a spouse who could then jump on that record and receive that benefit meanwhile. And that loophole was closed, so that no longer is eligible. And so what we have is what we call deemed filing, meaning if you have a benefit on your own record, you have to take your own record benefit prior to us looking at a spouse benefit. So you have to take your own benefit first before we look at a spouse. But if your benefit, your primary insured amount, is less than 50% of your spouse's primary insured amount, then there is a potential benefit that you could claim on that record. Now, your spouse, the number holder, has to be receiving the benefit, their own benefit on their own record, in order for you to do so. So that would keep in place in the same ages. Age 62 would be the earliest. There would be reduction on both your own and your spouse's, or you can wait, and at full retirement age, you're eligible for that maximum 50%. There is no delayed retirement credit for a spouse benefit while your spouse is still alive. Now, in a death claim, it goes from 50% up to 100% of the benefit, as long as the number holder did not take a reduced benefit. So here's one of these things, and I want to make sure we cover this, because if an individual takes a reduced benefit and they're the primary wage earner and their spouse is looking to try to jump on their record, maybe their spouse is much younger or there's some health issues, and they're thinking, I'm probably, statistically, I'm probably going to file a death claim. I expect my spouse to predecease me. Then if that number holder, if that predeceased spouse took a benefit prior to their full retirement age, then the widow or widower would be reduced down to 82.5%. They wouldn't get the full 100% in a death claim. So kind of going back to what we've talked about here, I jokingly say, if you don't like your spouse, then go ahead and take it early. Let them take that reduction if you predecease them. But if you're looking at and you're trying to be smart on how and who's going to receive, and you expect, I'll use me as an example. My spouse is 6 years younger. I have kind of, we look at our family history. I probably will predecease her, not only just the 6 years because of health issues in the family. And so I probably would not want to take my benefit prior to full retirement age, because then I'm going to affect her to where she would be reduced down to that 82.5%. So those are things that you'll have to take a look at, and you may not see some of that right away. So it's really important to read deeper into some of that information and then ask the questions. How would this affect us? Am I looking at everything I need to? And ask that representative who's helping you. Now, a divorced spouse is still eligible to receive. Again, same thing. It has to be below the 50%, or if that divorced spouse never worked and they're looking to claim on that number holder's record, as long as their marriage lasted over, and you see there, 10 years, then they're potentially eligible. Again, if they have their own benefit, they have to take their own benefit first, and then the remaining portion, they could potentially be eligible. The only difference between a divorced spouse and a current spouse is a divorced spouse does not have to wait for the number holder to start their benefit. As long as the number holder is age 62, then the divorced spouse is potentially eligible on that record. And that's probably the biggest difference there. And so even if a current spouse and a divorced spouse are both eligible on that claim, they still receive the benefit that they're eligible to. It doesn't decrease the other, and it never decreases. A spouse's benefit or divorced spouse benefit never decreases, or even a child beneficiary never decreases the number holder, never decreases. All right, so let's kind of move on here. Medicare benefits. I'm going to briefly, in the next kind of few minutes here, before I close up, just walk you through Medicare, because this is important as well. Medicare has their own website. I am from Social Security. I'm not from Medicare, but the confusion or sometimes comes in because where do you go to apply for Medicare? Through Social Security. So, I jokingly say, we're doing Medicare's work. I don't know how this happened. Someone lost a bet somewhere, and so we do their work. But it does make sense, because if someone's starting benefits and it's going to be attached to a certain age, then I can kind of see where that makes some sense. But there are 4 different major parts of Medicare, and this is where people really start to get a little confused. And I would say, go back to their website, especially that third part that it says what Medicare covers. It talks about these different parts. So Part A, hospital insurance; Part B, medical insurance. And those two together, Part A and B, is what most people think of when they talk about Medicare. It's Part A and B together. Part A is at no cost if an individual has paid the 40 credits into Medicare. So you pay a Social Security tax and you pay a Medicare tax as you work. Once you hit the 40 credits, similar to Social Security, then that Part A is at no cost to you. The Part B, the cost is the same for everybody, or the base cost, and we'll take a look at that in a second. The other is Part C, which kind of combines everything and gives a person kind of this plan. And those MAPs, as we call them, Medicare Advantage plans, is where providers say, medical providers, companies will say, we will offer to individuals with Medicare, they can take this insurance, and most of them don't even have any type of monthly premium on top of the Part B. It's just soaked in, and if someone uses that, then it comes together, and they even have prescription under that. So the individual just needs to make sure what type of Medicare or how they're going to apply their Medicare, whether they're taking a Part A and B only and using it in classic, knowing they're going to have 20% that they have to pay out of their pocket, which most people say, no, I need something else. So they may take a Medicare Advantage plan, or they may go through a broker and obtain a medical plan outside of that. Once they make that decision, and I would say this group here, HICAP, Health Insurance Counseling and Advocacy Program, is your best friend when it comes to Medicare. This group is the group that doesn't represent Medicare directly, but Medicare does not have, like myself, an individual that comes out and teaches you about Medicare. They take it and they say to the state, here's the grant money, you do your own advocacy in your state. The state here in California, we break up into counties, and so they say to the County of Orange, here's your portion, you teach your individuals about Medicare. Well, the county has so much going on, they have outsourced to Council on Aging Southern California, which does this program. Now, they're not going to sell you anything. They're simply there to teach you advocacy, as it says in counseling, at no cost to you. You can use their services, and they'll explain how Medicare works, what your options are. And so I say no one should go to start Medicare without first talking to one of their counselors that is certified to explain and help you with that. It's a great program. Again, you can go to their website, coasc.org, or call them directly, 714-560-0424, and they'll help you out understanding Medicare, or even post benefits if you have to file some type of, there was an issue, a problem, and you want to file a claim because something didn't happen right, they can help you with that. Now, I'll close with these enrollment periods. At age 65 is your initial enrollment period. That's when we're talking about when an individual is eligible to Medicare, or predominantly. It can be done through disability. I'm not going to really handle that today. I'm looking just at the normal course of life. It's at age 65, and 65 hasn't moved, even though Social Security ages have moved. The Medicare age 65 has not. So the initial enrollment is 3 months before, 3 months after age 65. But what you have to be aware of here is when you're talking about that is, if you look at this chart and you file for your Medicare in 1 to 3 months prior to age 65, your Medicare starts the month you reach age 65, that entire month. There is no partials. So if you come in and you apply the month you hit age 65, then you're going to have this 1 month delay. If you come in 1 month after your age 65, 2 months delay, second or third month, 3 months delay. So you have to really make sure that when you're looking at your initial enrollment, file timely. And what that normally means is filing prior to your age 65, so there's no delay, so that you don't have any issues of non-coverage that you would need. Now, if you're working and you have coverage through your employer, group healthcare coverage, whether it's you or a spouse that continues to work, after age 65, you still don't have to file for Medicare. You can postpone or wait. You don't have to tell us anything. You just wait, and you're going to have special enrollment where you would have 8 months in order to file for the Medicare without any penalties. So initial enrollment, a 7-month window, but normally it's that first 3 months, so it starts right at age 65. Or if you're covered through a group healthcare coverage through your current employer, it has to be a current employer or a spouse's current employer, then you have special enrollment and you can wait. And from termination, not if you take COBRA or any special handshake, from your termination, you have 8 months to file that. And the general enrollment means you missed all of these. There's going to be heavy penalties both in when it starts. You can only file between January and March. It's effective in July. And for every year that you did not have coverage after age 65, you're going to have this 10% increase penalty on your Part B cost for every year that you went past 65 without coverage. And so I've seen some people with 40, 50. The most I saw that I remember was about 80 or 90% that an individual was going to cover because they didn't want to take Medicare, thought they were going to beat the system. And so when they came back in, they had this excess or this penalty. So just be careful on the effective dates, the initial or when you need to enroll, whether it's initial or special. Once you start your benefit, the base premium currently this year is $144.60. So just keep that in mind. $144.60 is this year. We'll see at the end of the year. Then by December at the latest, they'll announce what next year, 2021, what the standard Part B premium will be, and we'll figure that out. And if you have, and you can see here in this chart, the modified adjusted gross income, there's this income related adjustment amount, an IRMA, income related adjustment amount. If you have these excess amounts, then if you earn over and you look at those brackets, then you have the standard premium plus an additional charge on top of that premium. So you just want to see where you're going to lie with that, and where you look at 2 years previous. So 2020 Medicare would be established by 2018 income. And if you have stopped working, let's say 2020, and 2018 income shows all of your earnings and you're below one of these brackets when you actually start, then you can file a waiver. That's an SSA 44, which is a life-changing event form for income-related monthly adjustment. And you can say, hey, I know that 2 years ago I earned and it put me in this other bracket, but this current year I estimate that I'm going to be at under 174,000, so I shouldn't have this additional amount on top of the standard premium. That's really important because some people don't hear that or know that they can file that request. Now, when you go to apply for benefits, as you can see here, when you apply, there's 3 methods: online, our phone, our 1-800 number, or in your office. But during COVID right now, I have that scratched out because you cannot walk into the office, and it's only by appointment for those that need to be in a face-to-face. And again, most people do not need a face-to-face. So what we ask is, we're not closed to the public, we're open through our phones. So call the local number. Normally we say, let me go back, we used to say, call the 1-800 number. And that's not what we're saying right now. In this time period, I'm saying, call your local number. So you can set up an appointment, and then a representative will call you and take your claim if you want to do it. And so in lieu of in face or person to person, you're going to do it over the phone, which still gives you that personal touch if you need that. I still recommend doing it online. It's much quicker. The average is that it's less than 15 minutes. So I say it's even better than Geico, less than 15 minutes, and we're going to pay you money. But do look at these numbers here, the different numbers of our local offices. You can call those if you have questions, if you need to set up an appointment, use the office. This would be in lieu of walking into one of our offices, just call our office. Now, there may be a little bit of wait depending on how many people are trying to reach, but we have our staff, our representatives that will jump on and try to answer those calls as quick as they can. All right, so we now are at the end of my presentation, and which would be the appropriate time if there are any questions or anything that I can answer for you.
Great.
Right
well,
now.
Jeffrey, thank you so much. I mean, every time I hear you speak, which has been a few times now, you've been so kind to come in, I always learn a little bit more each time. So clearly it can be very confusing. I think you simplified it for a lot of us. Thank you for addressing the Medicare question. A lot of people think that it is part of Social Security, so I appreciate you doing that. We have had HICAP come in, speakers from them come in and do events for us, so we'll maybe get that scheduled in 2021. But thank you for all the great information. And you do have quite a few questions, so why don't we get to that? But just to let everybody else know too that this was recorded. It will be on our website, this presentation, if you want to go back or share it with a friend. I suggest you go to apprium.com and you can see it all over again. But you have the phone numbers as well and so on. So here's your first question. I am a widow and turning 60 next year. My husband passed away at 53 years of age, and he never clearly started benefits. My understanding is I can access my late husband's Social Security benefits as long as I'm not remarried. And if that is correct, and get married after age 60, do his benefits stop?
Excellent question. And first of all, I'll answer that by saying, I'm sorry to hear the death of your husband, and our condolences. I know it's a difficult time. And so what we do from Social Security because of that is for a widow, you are allowed to file a claim as early as age 60. So different age limit or rules from a survivor claim and a death claim than in a life claim if the spouse was still alive. So age 60 is the earliest point at which one can receive it. But what does remain the same is the income limits. So 18,000, while you're under your full retirement age, you can only earn up to 18,000 or whatever the current year limit is. So if you're no longer working and you're below that 18,000, then yes, you could start the survivor benefit and receive that, and you'd be fine. To answer the other question as well is yes, if you're receiving survivor benefits, you turn 60 and you remarry past age 60, not a problem. You're still eligible to that benefit. Now, the confusion comes in with spouse benefits is in a divorced spouse. If they're taking while that spouse is still alive and they're taking a divorced spouse benefit and they remarry, doesn't matter their age, they're going to lose that benefit, but not in a survivor claim. So just in case someone says, oh no, you can't get remarried, they'll take it away. Not in a survivor. Past age 60, you can remarry and still take the survivor benefit. Hopefully I answered. Did I answer all of the questions on that one, Rhonda?
I think so, yeah. That made, and if, again, we have the phone numbers, and you can reach out to us as well at Apprium, and we can walk you through it if need be. Okay, for another question, I thought this was a good one as well. I will reach full retirement age in February of 2021 and plan on taking my husband's survivor benefits as it will be higher. Will the 66 and 2 month rule still apply? So 66 years, 2 months.
66 and 2 months would be your full retirement age. So if you're turning 66 in February of 2021, then yes, you would have to add that additional 2 months. So then April would be your full retirement age month. If you have benefits on your own record, the one thing strategy-wise that you need to look at is, I hear what you're saying where the benefit on the spouse record is higher, but just keep in mind too, if you take that survivor benefit, which again, you're going to be below the income limit as long as you're not above the 48,000 in the months prior to your full retirement age in 2020. So you could start in January with minor reduction off of that survivor benefit, again, 0.5% per each month. So we're talking 1 month or 2 months or 3, 0.5% or 1%, whereas you would get the rest of that portion. You probably would never make up that difference in your lifetime, meaning it's kind of a bonus to start a little early. I would take a look at that. But the other thing is, even if you start on that survivor benefit, if your benefit at age 70 with the increase surpasses what you're eligible on the spouse benefit, then at that point you can jump over to your own record. If it will never surpass it, that's fine, but you need to kind of check that and just make sure. It's a very small percentage. I can't remember, it's like point something percent of people that occurs where they jump on a survivor benefit and don't realize that their own benefit because of the delayed retirement credit surpassed the survivor benefit and they never jump on their own. So you just want to check that and make sure if there's any point.
Especially with survivor benefits, I think that it's really important to make that appointment or call to see what, what benefit is going to be the most beneficial to you at the end of the day, and what puts more of that benefit in your pocket. So that's why talking it through with an agent is clearly going over your specific situation with an agent is so crucial, because a lot of times people just sign up for what they think based on what they've been told by friends or family members, and they may be leaving some money on the table. So that
Correct.
was right.
If I can, Ron, I'm going to interject here. We have a 3-month system limitation, meaning you can't apply earlier than 3 months to when you want your benefit to start. But you have a 3-month buffer there. And so say this individual did want to start in January, I would suggest, making an appointment in November or in December and review that and see, is there maybe some benefit to me starting in January,
Right.
maybe on my own record, or just whatever it may be, because maybe you're going to wait till you hit your full retirement age, but you can take your own benefit for 1 month and gain that. There's just a few little options there
Right.
that may make it beneficial.
Sure. Yeah. Great point. Great point. Okay. Here's another one. Let's see. How can I get taxes deducted from my Social Security check I'm set to receive in January of 2021?
Okay, so we only can reduce the federal tax, and that would be by filling out a W-4V, which would then say, I want X percent to be taken out of my Social Security benefit. Other than that, we do not do it. You have to instruct us to. It would come from you, and I believe it's 3 or 4 choices now that you have on a percentage amount that you can request for us to remove. But again, only federal, not state.
Great. I think we have time for one more, but if we don't get to your question, as I mentioned, we will send you an email answering that for you. So the last one here I see, this is a good one. I'm recently retired from a corporate company and starting a position which is a 1099 employee. Should I continue to pay into Social Security?
Well, the 1099, if you receive a 1099, what we're going to do is we're going to look at what your net income is. And on your net income is where you're going to pay your Social Security tax on. So it's not whether you should, by law, you have to. So it just depends on how much. So you have to pay on the net amount, and you'll get credit for whatever that is. It's going to, it will help your Social Security benefit. Depending on whatever that amount is, it goes back into those high 35. So you still
your
want
net amount, like after your deductions, if you're a 1099 employee. So you're saying the net amount after deductions, and that's what they'll have to pay on Social Security on.
Exactly.
Okay.
And again, that's a law. So you would have to, and whoever does your taxes or helps with your paperwork would know that.
Great. Well, again, I think we're right on time here. Jeffrey, thank you so much. Again, we really appreciate your time. I thought it was always, again, educational, and you make it seem so simple. I know that there's going to be lots of questions, because people, tend to forget, and if you're not close to that age yet, then, again, this is just informative. So, again, all of the tips that Jeffrey gave you, think about, call us here at Apprium to discuss it, and we can incorporate it into your financial plan. We can follow up with any questions. You can email your wealth manager directly. I encourage you to set up your appointment, as I mentioned in the beginning, with your wealth manager for a review. I know that it's virtual right now, and it probably will be for the next couple of months. Hopefully we get back to some type of normalcy soon. But until then, this is the best that we can do. So I look forward to seeing all of you again as well. Real quick, I have secured our next WOW event. It will be on December the 8th. Expect that invitation emailed or mailed out to you in the coming days. It's with one of my favorite authors. She spoke at our WOW events over the last several years, Susan Alpert. She's going to be talking about Later is Too Late. It's a fascinating read, but also a lot of really great tips on being prepared in the event of a death of a loved one. So Again, you're going to get the survey here in the next few minutes. If you wouldn't mind in the next day or two taking some time to fill that out, I would greatly appreciate it. We always want to improve and do better, and would love any feedback. So again, Jeffrey, thank you so much. Everybody stay safe, stay well, social distance, wear your masks for the time being, and we look forward to seeing you in person again very, very soon. So take care, and thank you again so much, everyone.